What's up, investing iguanas? Iggy here, your friendly neighborhood financial analyst, ready to dive into the latest scoop on Starhill Global REITs. In this video, we'll uncover whether this retail REITs is still shining bright or if it's starting to lose its luster. Imagine you're strolling down Orchard Road, Singapore's iconic shopping belt, and you stumble upon the magnificent Wisma Atria Mall. This prime property is just one of the 9 high-end retail gems in Starhill Global REIT's portfolio, spanning across Asia-Pacific. But is this REIT still a worthwhile investment? Let's find out. Starhill Global REITs, a prominent real estate investment trust with a focus on retail properties, has a diverse portfolio that spans across the Asia-Pacific region. In the third quarter of its financial year 2023/2024, it reported a slight increase in gross revenue, which grew by 0.7% compared to the same period in the previous year. This is indeed a positive indication, suggesting a steady growth in its top line, which is the company's total revenue or sales. This growth in gross revenue is a testament to the company's strategic investments and effective management. It reflects the potential of the retail market in the Asia-Pacific region and the company's ability to capitalize on this potential. The increase in gross revenue could be attributed to various factors such as new tenant acquisitions, positive rental reversion, or improved occupancy rates. However, it's important to note that while the top line showed growth, the net property income experienced a slight dip. Net property income, which represents the actual cash flow from operations after deducting property-related expenses, fell by 0.9% compared to the same period last year. This could be due to increased operational costs, maintenance expenses, or changes in the tenant mix affecting the rental income. Now, why did the net income dip despite higher revenue? The question of why the net income dipped despite higher revenue is indeed intriguing. It's important to understand that revenue and net income are two different financial metrics, and an increase in one doesn't necessarily mean an increase in the other. One possible reason for the dip in net income could be higher operating expenses. Operating expenses include costs related to the day-to-day operations of the business, such as maintenance costs, management fees, and marketing expenses. If these costs increase, they can eat into the net income, even if the gross revenue is growing. Another potential factor could be currency fluctuations. As Starhill Global REITs has properties across the Asia-Pacific region, it's likely that some of its revenue and expenses are in foreign currencies. When the value of these currencies fluctuates, it can impact the net income. For example, if the value of the foreign currency decreases compared to the Singapore dollar, the revenue from overseas properties when converted back to Singapore dollars would be lower. Similarly, if the expenses in the foreign currency increase, it would lead to higher expenses when converted back to Singapore dollars. Despite these challenges, there's a silver lining. The occupancy rate of Starhill Global REIT's properties remains high at 98%. This is a strong indicator of the trust and confidence that tenants have in the REITs. What's even more impressive is that all of its Singapore properties are fully occupied on a committed basis. This means that all the available space in these properties has been leased out, ensuring a steady stream of rental income for the REITs. When we talk about occupancy in the context of a real estate investment trust, REITs, like Starhill Global REITs, another crucial factor to consider is the weighted average lease expiry, also known as WALE. In this case, the WALE stands at a robust 7.8 years. This is a significant figure in the world of REITs, and here's why. The WALE is essentially an indicator of the average time period until all leases in a portfolio are set to expire. A longer WALE means that most of the tenants are committed to staying in the property for a longer period. In the case of Starhill Global REITs, a WALE of 7.8 years suggests that the majority of its tenants are locked in for the long haul. This long-term commitment from tenants provides a certain level of stability and predictability in the REITs' cash flows. It means that the REITs can expect a steady stream of rental income for the next 7.8 years on average, barring any unforeseen circumstances like lease terminations or defaults. This stability is particularly beneficial for the REITs' investors, as it reduces uncertainty and makes future cash flows more predictable. Moreover, a longer WALE also reduces the risk of vacancies. With tenants locked in for longer periods, the REITs doesn't have to constantly find new tenants to replace those whose leases are expiring. This not only saves on potential leasing costs, but also ensures that the occupancy rate remains high. When assessing the financial position of a real estate investment trust, REITs, like Starhill Global REITs, one of the key metrics to consider is the gearing ratio. The gearing ratio is a measure of the level of debt a company has in relation to its equity. It's a crucial indicator of the company's financial leverage and risk. As of March 31st, Starhill Global REIT's gearing ratio stood at 37.2%. This represents a slight increase from previous periods. While an increase in the gearing ratio might initially raise concerns about the company's increasing debt levels, it's important to put this figure into context. The regulatory limit for the gearing ratio for REITs is 50%. This means that a REIT's total borrowings should not exceed 50% of its total assets. With a gearing ratio of 37.2%, Starhill Global REITs is comfortably within this limit. This suggests that the REITs has a relatively moderate level of debt and is not overly leveraged. Moreover, it's worth noting that Starhill Global REITs has a well-managed debt profile. The weighted average maturity of its debt is 2.7 years. This means that, on average, the REIT's debt obligations are not due for repayment for another 2.7 years. This gives the REITs ample time to plan its finances and ensure that it has sufficient funds to meet its debt obligations when they fall due. Starhill Global REIT's portfolio is valued at a whopping $2.8 billion, comprising 9 high-end retail properties across Singapore, Australia, Malaysia, Japan, and China. One of the standout assets in Starhill Global REIT's portfolio is the iconic Wisma Atria Mall. Located along Orchard Road, which is known as Singapore's prime shopping belt, Wisma Atria is a landmark in its own right. This mall is not just a shopping destination, but a symbol of the vibrant retail scene in Singapore. Its strategic location in the heart of the city's shopping district makes it a hot spot for both locals and tourists. The mall offers a diverse mix of retail, dining, and entertainment options, catering to a wide range of consumer preferences. Its tenant mix includes a variety of international and local brands, making it a one-stop shopping destination. The mall's modern architecture and innovative retail concepts also enhance the shopping experience, making it a preferred choice for many shoppers. The inclusion of such a prized asset in Starhill Global REIT's portfolio not only boosts its overall value but also contributes significantly to its revenue. The high footfall and strong tenant sales at Wisma Atria translate into steady rental income for the REITs. Moreover, the long-term leases with tenants provide a stable cash flow, further strengthening the REIT's financial position. In the face of an uncertain global economic outlook, the management of Starhill Global REITs remains steadfast and confident in their strategic approach. This uncertainty is fueled by various factors such as high interest rates and geopolitical tensions, which can have a significant impact on the financial markets and the real estate sector in particular. High interest rates, for instance, can increase the cost of borrowing for REITs, making it more expensive to finance property acquisitions or refinance existing loans. This can put pressure on the REIT's profit margins and potentially impact its distributions to investors. Geopolitical tensions, on the other hand, can create instability in the markets where the REITs has properties. This can affect consumer sentiment and spending, which in turn can impact the occupancy rates and rental income of the REIT's retail properties. Despite these challenges, the REIT's manager is committed to a strategy of proactive asset management and prudent capital management. Proactive asset management involves continuously enhancing the value of the REIT's properties through initiatives such as asset enhancement, tenant mix optimization, and active lease management. The aim is to keep the malls relevant to consumers and maintain healthy occupancies, which are crucial for generating stable rental income. Prudent capital management, meanwhile, involves carefully managing the REIT's debt levels and financing costs while ensuring sufficient liquidity to support its operations and growth initiatives. This includes strategies such as diversifying funding sources, staggering debt maturities to avoid concentration of refinancing risks, and hedging against interest rate and currency volatility. Alright, investing iguanas, that's a wrap on our deep dive into Starhill Global REIT's latest financial performance. We've explored the numbers, analyzed the occupancy rates, and even peeked into the REIT's debt situation. Now, it's your turn to weigh in. Do you think Starhill Global REITs is still shining, or is it starting to dim? Share your thoughts in the comments below, and let's keep the discussion going. And don't forget, if you found this video insightful and want more financial wisdom from yours truly, smash that like button and hit subscribe. It's the best way to stay up to date with all the latest investing news and analysis delivered straight to your feed. Until next time, keep those investing gears turning, and remember, the path to financial freedom starts with knowledge. See you in the next one, Investing Iguanas.